Thanks for the introduction, and thanks to Red Cloud for this invitation. Special thanks to Ron Stewart, who's a mining analyst at Red Cloud, who asked me to give a presentation. He invited me here about 6 months ago. So, and a couple of months ago, I thought, well, what am I gonna talk about? So, you know, the bull market was sort of starting to get pretty warm. I've been on the buy side for 20 years. I invest myself. I still do a fair bit of investing today as well. One thing Dave missed there that I basically run a little fund inside a gold mining company, which is quite fascinating, actually. But I'm really invested in those juniors, really gold explorers in North America. But I'm invested in them to help them make a discovery, not necessarily to make money out of the equities. So I thought it's topical. You know, we're in a bull market right now. Everybody's having a bit of fun. The stocks are going up. It's pretty volatile. So I thought I'd just share some of my thoughts. Really, this is kind of investor to investor. Got a few data points on where we are in the market, maybe some behaviors you can follow, which may help you make better investment decisions too, because I've been through various bull markets, some small, some big, made lots of mistakes along the way, made a little bit of money as well. So hopefully by the end of this, there's a couple of little snippets here you may take away that may help you with your own investment decision making. It's working? There we go. So a few phrases there. Sorry, a few interesting, funny sentences. There's hundreds of these on the internet. You know, half of them come from Warren Buffett. I mean, we all know that during the roaring bull market, as they say, even turkeys fly in a hurricane. And a fund manager I spent a lot of time with, he basically, and I am a mining analyst, was a mining analyst, he basically said to me, you cannot afford a mining analyst in a bear market, but you do not need a mining analyst in a bull market. And that's a pretty good point that, you know, in a bull market, basically everything goes up. You just need to know, you just need to be in it. You can try and, you know, pick the ones that go up the most, and I think that changes as the bull market evolves, and I'll touch on that a little bit later. This is I suppose, getting into behavioral stuff here. It is very difficult to buy something when you really hate it. And I know I've done this myself. I've looked at my portfolio at the top of the market. I'm really happy with everything. I've subsequently learned that the stocks I'm most happy with are the ones I actually should be selling at that point. Doesn't mean I've got to sell everything, but you should always be clipping a bit of money. And I always say to people when they say, I know people and they raise a bag of cash and then they're desperate to put it back into the market 10 minutes later. I usually say to them, go buy something real. You know, go buy a new car, treat your kids, go on holiday. You know, you don't need to shovel it back in the market immediately. That's a good point there. The fourth one, all people are most credulous when they are most happy. So you're really happy, you're looking at your statement, but that generally means you will probably believe in some bullshit you told in some meeting that this is the next great story. So it's actually a great time for promoters to come out of the woodwork and pitch to raise money. I've experienced that myself. It's a bit harder to actually catch me these days. And there's a couple more there at the bottom. The last one is from quite an interesting book. Some of you may have read this. It's quite a short book. It's kind of flowery English. But it's called The Short History of Financial Euphoria. It goes all the way back to the tulip bubble in the Netherlands in the 1600s, and then the South Sea bubble. And it explains all these bubbles and just how humans repeat this behavior over and over and over again. And I've experienced it myself, you know, without ever sort of researching it. The euphoria you feel when you're at the top of the market, it just makes you make weird decisions, and you've got to try and fight that and think as an investor. So this is a slide I use. I usually annotate it. This is a slide I use in a short course that I give to myself and several other people. We give this short course to geologists who are interested in learning about the financial market, and there may even be a couple of geologists here in the room that have attended it. We've probably given it to about 500 people over the last 10 years. And just very simplistically, what I want to point to there is, obviously, we all know that the cycles in our sector, they go up and they go down. And those cycles are really differences in, I call it market sentiment, which people call beta. You know, when you're making money that's just due to beta, I mean, that's great. It's kind of easy. But myself, I would always, as a fund manager, I'm always looking for alpha. You know, I'm always looking for stocks that are going to outperform the market, not necessarily just ride the market waves up and down. So, you know, everybody's pretty happy there at the top. But I think at the top, we do see what I call peak capital misallocation. We see a lot of capital go to places and people and projects that it actually shouldn't go to. And also, I think we see peak emotion at the top too. I think people get pretty emotional. I've talked to some people in the last few weeks, and they're kind of giddy. And then one day, the gold drops $250 an ounce, and I can remember working at a gold mine in Papua New Guinea, and the gold price was $250, and it dropped $250 in one day recently. People are getting whipsawed by that emotion. It's quite hard to fight. So that's something you've got to be aware of as well. It's quite hard to, we're all humans, we're all emotional to different degrees, but the more you can take that emotion out of your investing and maybe have more emotion at home, that would be, that'd probably be better for everyone. Same in the bear market. I think we see peak capital under allocation at the bottom of the bear market. That's when you really should be shoveling money into the market. It's very hard to do because you hate your mining stocks at the bottom. You hate the sector. It's crushed you. You really don't want to be there. And again, you're very emotional, but that's the time when you should be writing the big checks, ideally in the better companies, so you get a bit of beta and ideally a lot of alpha. So FOMO, I think everybody knows what FOMO is. Yeah, the fear of missing out. It's a pretty powerful emotion. I think you can ascribe all sorts of attributes to it. I think it's regret and greed and sloth. Most humans want to make money as quickly as possible, as easily as possible. Most humans, we invent things to make our life easier. The book I mentioned there, it goes back to financial euphoria events. A lot of these are driven by FOMO. People do invest because their neighbor's making more money than them, and their neighbor's bragging about it on social media or whatever, or they're just bragging about it over the fence. And you hear all these people bragging about their performance on the internet, on Twitter and everything else, and it just drives people to make emotional decisions, and that they ultimately do make quite a few mistakes. And I think it's very easy when you see people who are suffering, let's call it, from FOMO. I think they can be quite easily manipulated by people who know what they're doing and maybe a little bit, let's call them a little bit ruthless. We've all met people like that, but you just got to be careful. Yeah, if you feel like you may, and I think there's another slide at the bottom actually. I'll get to it now. This emotional wave, let's call it. You see there's a FOMO there. You're feeling great at the top. I'm probably telling most people here stuff that they don't already know, but I think it's good to have a reminder every now and then, and maybe you got to sometimes just check your own emotional health as to where you're at on your investing. You're really happy when your book's looking really good, but you probably then, and even if you sell something, you do want to go straight back in. You do have that fear of missing out, even after you've made money. So the next slide, I kind of nicked these off somebody off the internet, and I won't run through all of those. I think this presentation might be available afterwards, but it's quite interesting to run through some of those and maybe ask yourself, do you say those things to yourself every now and then? Are you a FOMO trader? So my recommendation would be to try and recognize when you're suffering from FOMO and try and avoid it. Myself, now, my personal investing, what I tend to do, I tend to wait for investments to come to me. I don't actively go out there. I don't go, I've got $1,000, I've got to put it in the market as soon as possible. I meet a lot of people who feel like they just can't have cash in their account and they just have to invest it. They just can't sit on cash. I prefer to sit on cash, and then when something good pops along, maybe it pops in my inbox. Usually it's at events like this where I come across something. I was in Montreal last week at an exploration conference, came across a very good idea that just completely came out of left field, completely unexpected. But I'm pretty certain you won't find those ideas by sitting in your house. And the only ideas you'll find on the internet is by probably somebody manipulating you through FOMO, trying to get you to buy their deal. So I find just meeting people and talking to people is a great way to find good ideas. But I'm quite a passive investor. But if I see something I really like, I will write a sizable check that makes a difference. So yeah, investor FOMO drives fund flows. You probably heard people always talk about fund flows. Again, I'm talking to investors here. You know what I mean. Big dollops of money sloshing around the world. That's the gold ETFs there. Again, just showing a few data points here of sort of where we are right now. In 2024, there was actually outflows in the gold ETFs around the world. H1 2024. started to pick up in H2 2024, and then year to date 2025, you've seen this for the gold sector anyway, a significant amount of money come in, and that's just to the end of September. So, and probably a lot of people get this, the Junior Mining Network email every morning. You know, for years we kept looking at it. It's like, oh, I'm raising $1.5 million. Oh, I'm raising $3 million. Now, I just randomly picked one there, you know, and we're seeing 24, 20, 30, 49, 55. You know, seeing these huge financings. Like it's an interesting time right now. There's a lot of money coming into the mining sector, into the commodity, but also coming into the equities, and I suppose that's great. Some of that will be misallocated, but a lot of it won't, and it's great for the sector. It's great for us long-standing investors who've, for most years, are just trading shares between one another. You know, so there's actually a lot of money now coming in from new people, which is great to see. Yeah, gold mining shares. This is going back about 3 years. So you know, the last quarter there, the last full quarter, that jump is amazing. You know, significant. This obviously September was a pretty hot month. It's pulled back a bit now. I suspect October's not as good, but a lot of the financings would have been in train, and they've probably closed. And then the same data, sort of a different source, but going back, I think that's going back about 10 years. Yeah, you can see there, obviously, the last period on that graph is quite significant. That's the biggest amount of money raised by, that's basically covering mining stocks in North America. That's the best, whatever that is, month, or I think it's a month rather than a quarter. That's going back 10 years. I'm not sure what happened in 2014. I seem to remember that being a terrible time, but yeah, so you know, it's been pretty amazing. It's been a pretty strong bull market in recent weeks. It doesn't feel like that in the recent days, but you know, little pullbacks. I think the pullbacks pretty healthy. Some of you may have seen this float around the internet. You know, investors, gold investors, feeling pretty smug with themselves. Gold was at 4,100, 13th of October. You know, life's great. And then gold goes to 4,400. Only 10 days later, people are desperate because gold's dropped $250 in a day, and they're all emotional. They're all, oh my God, is it all over? And just making the point here that it is a pretty emotional time. You expect your emotions to be whipsawed. I always think the best portfolio managers are almost, you know, they have ice in their veins. They're just so unemotional. Unfortunately, I'm not built like that. I'm a little bit emotional, amazingly, for people who know me. The old stone face. But no, yeah. So you gotta fight it. Yeah, you gotta know you gotta feel. You know, you gotta understand how you're actually feeling, and don't trade too much on emotion. So I just threw this together, thinking about what you need for a bull market. You always need a spark. You need something to trigger FOMO. So I mean, what was the spark for the recent gold equity bull market we've experienced in recent months? I'm not actually really sure what the actual particular spark was. I mean, obviously the gold price going up. The gold price has been climbing for a long time. I presume it just was the gold price, and maybe there was just pent up. Maybe there was a lot of people on the sidelines just seeing this crazy move in the gold price, and they wanted in. It was probably a big part of it was the gold producers. All of a sudden, they're making lots of money. I've got a slide on that in a moment. Yeah, so obviously that triggered FOMO from some external fund managers who are seeing great returns. They're getting good returns in some of these AI stocks, or they have been recently, and they wanted a bit of the gold sector too. Now, to maintain the bull market, you need some fuel. You know, so how compelling is the investment theme? Governs the talk, I suppose. I mean, how far it actually goes, how far it goes up, how far it continues to go up, and then the duration as well. You know, is this a new structural thing? Are we going to stay up here, or is this just a little ephemeral blip and it's going to pull back down? So really makes me think anyway about what is the shape of this bull market. And I don't think people talk about that very often. And the next slide, I think, is on talking about what the shape of the bull market could be. I don't try and predict the future, but it's interesting to think about it. And then something always kills the bull market. Every bull market ends at some point. So a big thing I find in the gold sector in the past has been competition from alternatives. So it was quite a hot market. If you remember the older people in the audience, you know, in the 90s was a pretty hot market, and I think the spark in the 90s, the mid 90s, especially in Canada, was the discoveries of Red Lake, or the big high-grade zone at Red Lake, the diamonds in the north, and Voisey's Bay. If you look at the history, they all occurred within about 18 months of one another, and I think that drove that greed to back explorers. It was an amazing time, but it was killed, I think. Bre-X didn't help, but it was really killed by the dot-com boom. Dot-com boom just wiped it out for 4 or 5 years. There was something else for speculators to rush into. Anybody in Vancouver with a dot-com in their name was raising 10, 20, $50 million, and the miners were just getting no money. So I think you need, and interestingly what's going on right now is that the whole AI thing is a big boom as well, a big bull market, but it doesn't seem to be impacting the gold sector. Now the gold sector is tiny compared to the AI, so it's almost like they're running in parallel. So it'll be interesting to see if something else comes along. You know, we've seen cannabis in the past basically kill the mining sector for a while, that the speculators were in cannabis, the speculators went into crypto, you know, blockchain. So I don't know, maybe we don't know what it's going to be. I can't actually predict it. You know, the spark when I first joined the buy side in 2004, the spark there was China, the whole Chinese growth, and that went on for a long time. And that was a great bull market. I thought I was a superstar. Every year I was super double-digit returns, 04, 05, 06, 07, then yeah, I got my head handed to me in 08. But even that was a great lesson. But when you look back, 08, the GFC was a dip. It was a V. It just went like that, and then it went straight back up, and then it went all the way up to 11, and then sort of China slowed down. So bull market shape. Yeah, in a bear market, when I've been down at the bottom of a bear market, people often talk about, you know, what is the shape of the bear market? Is it an L? And they always have these English, sorry, not English, they always have these letters for the different shapes. I've seen people talk about L's and V's and U's and W's, but I never really hear them talk about the shape of a bull market. So I thought about, you know, what are the alternatives here? And again, I'm not going to try and predict what the shape of this bull market's going to be, but the characters tend to be a bit Cyrillic, not sure why. So, you know, we're going to have a weird one where it goes up and then it plateaus for a while, don't know. We're going to have an upside down V. Is this bull market going to be a spike? Don't think so. Can't see why it would be. Can't see why the gold price is going to scoot back down to 2,500 anytime soon. Is it going to be a strange upside down U? Are we going to have a bit of time at the top, or are we going to end up with an M? Are we going to have like a double top? Don't really know. Something to think about. You know, some people like to forecast the future and try and plan accordingly in their portfolios. I try not to. I try and focus more on alpha than beta. So in any market, you can make money with alpha. Beta, you just quite often just rising up and down with the tide, where the tide's going in or the tide's going out. So this is, I think, how I see some people trade in a bull market. I think early doors, maybe in any market, the quality tends to attract investors. And then I find once all the quality moves first, I think then portfolio managers tend to get driven into having to rotate because their Agnico or their Newmont or whatever they liked in their portfolios had the big move and it's kind of plateauing, and then all the mid-tiers start to move or the juniors start to move, and they get forced to rotate. And the reason they have to rotate is because most fund managers get marked against the benchmark, and they're forced to outperform. So outperform means you have to be better than the bottom 50%, and you've got to be fully invested. Most portfolio managers can't sit on 30% cash. So you're constantly trying to, under this pressure to actually rotate. Now the problem with rotation, I believe, is that, and I experienced this in Montreal last week. Yeah, the problem with rotation is I think the money tends to then go down to lower quality stories. And stocks tend to be bought primarily because they've not moved. It's almost like they're trying to find the next source of beta. They're not looking at alpha. They don't really care about the story. And even last week in Montreal, I had somebody say this to me. Oh, a portfolio manager I was talking to is just looking all down the sector and seeing which stocks have moved the least. And he was trying to rotate from his big winners into his ones that he thought they were going to move, irrespective of his knowledge of the company. It was kind of quite scary, actually. And I think when we're getting in the sort of the eighth innings of a bull market, people move into optionality stories. And by that, I mean the big 20, 30 million ounces in the ground, terrible metallurgy, terrible location, terrible infrastructure, terrible management even. It's never going to be mined. And then you start to hear the old EV per ounce type metrics come out, and people use that to justify buying a stock. And I think that is if you find yourself doing that, it's okay if you're a trader and you're nimble and you catch another leg of beta, but you're definitely not buying stocks for alpha. And I think that does result in, as I said before, that is the point of peak capital misallocation. I think at that point we're seeing the maximum amount of capital going into, let's call it, bad places. So the current gold equities bull market. This came out from Keynote a few days ago, based on, I think it was all the Q3 data. Just amazing. I mean, okay, our sector's pretty tiny compared to other sectors, but Keynote's forecasting there that in their coverage universe in 2025, they're going to make $25 billion of free cash flow. And in 2026, that's going to be $40 billion of free cash flow. And then the opposite of that is on the right there, shows how much their net debt. So they basically going to have net cash on the balance sheet of almost $50 billion by the end of 2026. That's amazing, but what does that mean? It means, and maybe we've just started to see it, they've been focused, the producers have been focused for quite a long time on, let's call it, fiscal discipline and, paying down their debt. They've been returning money to shareholders. Not a huge amount of M&A, but we have to see a lot more M&A. These majors have to start buying, the mid-tiers and shoveling a bit more money into the smaller caps. And so I did a little study. This is data from H1. This was the top 10 precious gold producers, top 10 gold precious metal producers in North America. And I was interested because a lot of them are shoveling money back to shareholders. And I was thinking, well, how much do they give back to shareholders compared to what they spend on exploration? And the ratio is 8 to 1 right now. They're giving shareholders 8 times as much money back than what they're spending on exploration. Now, I threw that out on the internet. On LinkedIn, I got quite a few comments back, and I was intrigued because the more I thought about it, my view is I don't think the precious metal majors, the miners, should do any exploration. I think they should just stop all exploration. And they should allocate 50 to 100 million or 150 million and invest it in their favorite juniors. Let the juniors do it. I think the juniors are a lot better explorers, they're a lot more nimble. I think there's a lot of wastage in the exploration groups of major mining companies. So that was really one takeaway from this, but I was quite interested in that ratio. And I don't think we're going to see the majors step up their exploration. If anything, can they give any more money back to shareholders? I suppose so. Do shareholders really care? Not really. They probably want them to, they're probably going to start saying, now it's time to grow. So I do think we are going to see more M&A coming. Just a quick one here. Gold, it's almost gone parabolic there on that chart, going back essentially 50 years. This came from Ronnie, who does the In Gold We Trust work out of Liechtenstein, I think. So we've seen 98 all-time highs in this current bull market, which is less than we've seen in the last 2 bull markets. You can argue there's all sorts of reasons for that. But also, just stress the point again, lots of all-time highs just means it's beta. Just means it's the market taking everything higher all at the same time. That's not an alpha reason. A couple of charts. Agnico, what a great story that's turned into, a proper Canadian superstar. $80 billion market cap now. Never really like to see share prices go a bit parabolic. Now that share chart is going back 40 years. So it's cheating a little bit. But I think we were due, I think people would argue that we were due a bit of a pullback, but pretty amazing what Agnico's done, and I saw them present in Montreal last week. Great company, slowly building that portfolio base in Canada, becoming a real Canadian superstar. They've drilled 1 million meters at Detour since buying it, and added at least 10 million ounces. So that's going to be a 1 million ounce a year gold mine, best gold mine in Canada. Newmont's a bit different. It shows, you can have these big spikes during happy times, but I put that one in there too because it also shows that the same company can fall pretty quickly when the music stops. So corporate M&A behavior now. So I've talked about investor behavior. This is corporate M&A behavior. Same slides, just showing there's a lot of money coming into the sector, but what that also means is issuers realize their share prices it's a good time to be selling stock. So you've got to be careful of that too. It's always a competition between the investors and the issuers. It's a bit of a tussle. So the issuers think it's a great time right now. There's a lot of money coming in. This came from a Regulus presentation. This is their view there in that yellow box, what they think happens in a bull market as a bull market evolves. You know, majors buy operating assets. We have seen some of that in the past, especially the big operating assets. Majors try to buy each other. I think they try to buy each other all the time. And then majors buy development projects. I do believe we're just on the cusp of that starting to happen. The developers have been the best place to invest in recent years, in my opinion, because they've been some of the cheapest stocks. So we've seen some relatively low-risk bolt-ons recently. Angus, Prime, you know, these groups got bought, Maritime and Northern Superior. And then, funnily enough, perfect timing for this presentation, Probe gets bought. I've been saying, I used to be quite a big Probe shareholder in my fund, and it was really because it's kind of a mediocre asset, but it's in a great location. And I think that's the type of project that some of these majors are going to be looking to pick up. Kind of an unusual acquirer in Fresnillo. The problem is, the challenge is, you know, it's a bad time when you start to see this. I think these were kind of 2010, 2011, massive acquisitions, $7-8 billion on assets, one in Mauritania, the other one in Zambia. You know, I think we can all look back and say, if you start to see these mega acquisitions, there's a problem. Yeah, we're nowhere near that right now. I sat through lots of gold presentations in Beaver Creek and Colorado Springs last month before, and they all seem very disciplined. Everybody, all the gold majors they all seem pretty happy right now with what's going on with organic growth. Final slide. A lot of people think bubbles are bad. You can read this yourself. This came from a guy, I think it was in the AI sector. He says, of course there's a bubble. Bubbles are good. He said bubbles align capital and talent in a new trend, and that creates some carnage, but it also creates enduring new businesses that change the world. So you can think about that, all this money coming into the mining sector and the new attention on it, critical minerals, whatever you want to call it. I think a lot of good comes out of it in times like this. All that capital, some of it will be wasted, let's say, but from it, a lot of good stuff is going to come too. So enjoy it. Remember to sell some at some point, and keep looking for alpha, and don't rely too much on beta. That's it. Thanks.